Okay, let's begin with the next chapter, that's material costs. So we are going to start off with this chapter. Uh, this is a very decently sized chapter. Apart from this labor and overheads, I don't think we have any big chapter. All the other chapters are like 2, 3, 4 pages, 2, 3, 4 pages, 2, 3, 4 pages, and that's about it. Yeah. So let's begin. So we have the definition of material, which says that anything, any commodity or an object that is used in the process of production or the making of the final product is material. It can be classified as direct and indirect. And the direct material is basically any cost that can be attributable to the end product. And please mark this. This is important. It says. Such identification should be done in an economical and feasible way. So you can tag or you can attribute any material to the final product, but if it is not economical or if it is not very easily done or if it is not feasible, then yes, that is a challenge. So one of the things that define direct material is how easily it can be done. Okay. Then we have indirect materials. Of course, some materials cannot be directly attributable, are basically the indirect material. Then the next point we have is the 3E principle. That since material is an important element of cost, you've got to be following these three principles, the 3E principle. The first is economy while you're buying, efficiency while you're handling and processing, and finally effectiveness in producing the desired output. So that's a 3E model: economical, efficient, and effective. Okay. Then the importance or objectives of material control. Why do you want to have a material control? Because the quality of finished goods depend on the quality of input, and since material cost is a significant portion, it affects the cost of finished goods as well. And so the quality of finished goods and the cost of finished goods both are largely dependent on the quality and the cost of raw material, which is why you want to have a control. Then it says that since without material production cannot continue, control is required to make sure adequate material is required for production continuity. So basically, the idea is that you will have to have to ensure production continuity, and to do that, you need material. So you need to make sure that material is available. Okay. Then waste and losses are inherent to the material depending on the type of material and processes, and therefore requiring control. So usually what you lose is material, so you need to have a proper control over it. And lastly, informed decisions can be made if regular and updated information is available, and therefore it requires control. So these are basic points. The first 3 points are good enough for you to remember. You can remember only one of the next 2 points and you'll be done. Okay. Then if you want to have material control, then what do you do or what do you need? So you need proper coordination of all departments such as purchase, finance, receiving, inspection, storage. So any department that deals around the material cost, you need a control over those guys. You need coordination over those guys. Okay. Then you need standard forms for placing an order, receipt, issue, etc., etc. Okay. Then you need an internal control system to understand that all the transactions regarding the materials are approved and verified. Okay, so no material should be going across without being verified. So if at all it is changing hands, it needs to have proper verification. Okay. Storage of material is in the designated area with proper safeguards. This is important. Operation of a perpetual inventory system along with continuous stock checks. We will come to this in a while. And delivery of goods only against authenticated forms. So what all do you need to do to maintain control? The first thing that you need is coordination, standard forms. Then the third point is I would pick up the last one, that is delivery of goods only in an authenticated format. The internal control so that transactions are verified, storage of material in a decent environment, and a perpetual inventory system. What is a perpetual inventory system? As I said, we'll come to it again. So This is what we have done until now. Let's have a quick recap. We saw what is the definition of material, what are direct and indirect material, the 3E for materials, the objectives of material control as to why you want to have material control. Very, very easy. Quality and cost of finished goods are dependent on the raw material. Therefore, then your production continuity is dependent on material, which is why again, and waste and losses are inherent. Therefore, you need to have material control. Okay. How do you maintain material control? Coordination amongst all departments, use of standard forms, delivery to be done again in an authenticated form, internal control system so that the materials are verified, and the storage of material in a designated format. And lastly, the operation of a perpetual inventory system along with the continuous stock check. That again, we'll come to it in a while. Now, what are the areas or elements of material control? Where all do you need the material control? You need material control while you're procuring goods, while you're storing the goods, and while you're issuing the goods. Okay. So these are the three areas: while you purchase, while you store, and while you issue. Okay. Operations where material control are required, you can just read through this. This is very easy. And then comes in the material procurement procedure. Now, what is a material procurement procedure? It's a long cycle, stages, multiple stages where you'll have to understand what is done, how, and why. So that is what we're trying to understand over here in material procurement procedure. Okay. Firstly, a bill of material. Now, basically, what's a bill of material? A bill of material is it's like an ingredient list. Okay, so let's say you're cooking. Okay, while you're cooking or watching a cooking show, when they are about to prepare a recipe, they tell you that this much of this much of that, oil, etc., etc., etc. All of that is needed to make the dish. That is what is the bill of material in industry. So we kind of it's a predefined list of things that you'll need for your final product. Okay, it is usually made by the engineering department and then shared across by them to the production department, the purchasing department, the accounting department, the marketing department, etc., etc. Okay, and all of these departments have different uses. So if the purchase department, it helps them to understand how much to purchase. Production department helps them to understand how much of material are required. The stores department makes an understanding of how much do they need in their warehouse, and the accounting department uses to understand what kind of cost sheet they can draw out of it. Okay, so that's the bill of materials. After the bill of materials, what happens? There is an MRN that is issued. Now, this MRN, material requisition note, this is prepared by the production department and they are given it to the stores department. Okay, and based on this MRN, the stores will issue the goods. Okay, material requisition note. Then we have a small differentiation between the bill of materials and material requisition note. I want you to read that yourself. Third step rather comes in the purchase requisition. Now, what happens in a purchase requisition? It is basically given out by the stores department to the purchase department. Okay, it is a request to purchase raw materials, and to do that, to purchase those raw materials, the stores department gives out this form to the purchasing department. Okay, it is usually filled out by the storekeeper. Basically, he is the one who manages the stores. Okay. Now, the next thing that will happen is when they invite quotations. Okay, the purchase department will go out and invite quotations, and they will require all of these. They'll basically contact all of their vendors and ask them to send a quotation based on the quantity they want and uh, the quality, the specifications, the pricing expectations, the delivery timelines, etc. Once that is done, the vendors will send in their proposals. You will select one of the proposal. It will depend on a lot of factors apart from cost as well. So apart from cost, the reputation, the quality control, the kind of delivery schedules that he's offering, etc., etc. Okay. Once the material vendor is selected, then to that selected vendor, uh, the purchase department will issue a purchase order, PO. Okay, once that PO is given out, this PO is given then to the stores department, the receiving department, the cost accounting department, all of those parties who are connected to it. Okay. After the PO is given out, the materials are received from the vendor. The material will be received and it will be inspected by the stores department. They will do a thorough check. If the goods are fine, a goods received note is issued, and if the goods are not fine, they are returned back to the vendor using a material or a goods returned note. Okay. Finally, the goods received note that the stores department have actually given out. This will be given out to the purchasing department and the accounting department. Okay, and if there is a material return note, that is also given out to the reporting department, all of the purchase department and accounting department. Okay. Finally, once all of this is done, fine, and at the end, now the vendor from whom we got the goods is finally due for his payment. So we'll give them the payment based on the invoices that are received. The invoice that is received is matched with how many goods we accepted, how many goods we returned, all of that. And once that happens, we are in a position to pay the uh, supplier. And that is basically the entire process. Okay. And we have the valuation of material receipts right now. Once you've got the material, okay, what are the costs that you need to consider in putting across is what we are seeing. So we have the cost of the material itself, okay, and there are a few elements that we are going to talk about. So if there are discounts, okay, you will adjust those discounts except cash discount. You will not consider cash discount. All other discounts, they should be included in the cost of material. So let's say you got a material for 100, but you have a discount of 10 rupees. So you'll value the material at 90. Okay. But if you have material purchase cost as 100 and cash discount of 10 rupees, then the cost remains as 100 only. It will not come down to 90. Is that understood? Then taxes, any kind of taxes for which credit is available, you will not add that tax. If at all the credit is not available, then you will add in that tax. Okay. Penalty, no penalties are ever allowed in the cost of material. We already know that. And then there are a few other expenses that are given. First is insurance. Yes, you can add it to the cost. The commission and brokerage, yes, to be added. Freight inwards to be added. Cost of containers. Now, if there is a cost of container, if it is a non-refundable, then add it to the cost. If it is returnable, do not add it. And if it is partially refundable, then only add the portion which is not refunded. Okay. So let's say if it is 100 rupees and once you return the container, you get back 50. So you will only add 50 rupees to the cost. Okay. If you get back 60, so you're not getting 40 rupees. You will add 40 rupees to the cost. The portion of the cost that is not recovered. Okay. That will not come back. So that is an actual cost to you. So that portion is what you will be adding. Okay. Then you have shortage. If at all it is a normal shortage, then add. If at all it is abnormal, then do not add. Okay, I hope we are clear with all of this. I'll just explain it to you, the material container again. Let's say you bought the material and the vendor has charged 100 rupees for one container. Okay, and he is not going to take that containers, it is yours. So then add it to the cost. Then the other term may be like, you would get those 20-liter jars of bottles of water. Let's say you will give the empty jar, he will give you the money back. Okay, so it is fully refundable, which means that you don't have to worry about it as a cost because it is not a cost. Okay, so that is gone. You will not take up the cost for that. Then if it is partially refundable, as I said, let's say you paid 100 rupees for the container, you get the container, and then when you return the container, you only get 70 rupees back. Okay, So it means 30 rupees is going out of your pocket. Whatever has gone out of your pocket, that becomes the cost. Is that clear? And that's about it in the cost to be added or valuation of material receipts. I've spoken a lot. Give me a 2-minute break and I'll be back. So now we have the next topic as material storage and records. Okay, so who does that? The material storing and recording, all of that. That is usually done by someone called as a storekeeper. Now, who's a storekeeper? He is basically the one who manages the store. Now, what are the duties of a storekeeper? His primary duty is to make sure that all the activities are controlled in the stores department, and whatever materials he receives and whatever materials he issues, all of that is under check. He is also required to keep the safe custody of all the materials. Okay. He is also required to maintain the records for all the materials coming in and going out. Also make sure that there is adequate level of stock for everything. And in the material procurement procedure, you learn that he is the one who will initiate a purchase requisition. So we'll have to do that as well. So all of these are the duties of a storekeeper. Basically, make sure the records are kept, materials are kept in a proper manner. All the other activities in the stores department are taken care of. He's supposed to maintain the records, maintain adequate level of stock, and also initiate a purchase requisition. Okay. Now, how does he maintain the records? What are the ways of recording or maintaining the records? So you have three ways. One is called as the bin card. The second one is called stock control card, and the third one is called as stores ledger. Okay. Now, what is a bin card? Bin card is basically a small card which is placed outside the box in which the material is kept. So whenever someone takes out the material from that box, he will write an entry that I have taken out so many materials. When you refill that, you will write an entry, I have put in so many materials. Okay. So it's a small card placed outside the box itself. Okay. What are the advantages of it? The disadvantages of it? Very, very simple. You can read that yourself. Okay. And second is the stock control card. Okay. Now, the stock control card is basically a card which holds the entire list of items, and these lists of items are maintained with the storekeeper. Instead of keeping it in front of each box, we have one card which is there with us at the storekeeper's gate. Okay, with the storekeeper itself. Okay. Now, what are the advantages and disadvantages? Okay, firstly, you will have to know that both the bin card and stock control card are having only and only quantity data. They don't have the cost data. Okay, there is only quantity data that is there. Only the stores ledger, which is the third category of record, is where you will have the quantity and the rate information both. Okay, why do we have that? Because the accounting department takes care of the rates. Okay, you are not supposed to let know of the lower stuff that what is your purchase price of a particular material. Okay, that can get a little risky, which is why we are trying to understand that. Okay, now once this is done, these are the three ways of doing the accounting for materials. So you have a bin card, a stock control card, and a stores ledger. Okay, we have done all of that. I want you to read the advantages and disadvantages, and then we have a differentiation between the bin card and the stores ledger. Okay, so there are basic points over here. Bin card will have hold only quantity. Stock and ledger will have the quantity and rates both. And then one is maintained by storekeeper, the other is maintained by the cost accounting departments. Then in the bin card, you put down the entry every time the transaction happens. In a stock ledger, you will put it after a certain time, maybe weekly or in 15 days or something like that. Okay. Bin card will have the transaction advice for everything, all transactions, whereas a stores ledger will have all the transactions for a particular period summarized and posted. Okay, so that is basically the kind of differentiation that you can find. Okay, next, inventory control. Okay, that how are we going to maintain inventory control? I want you to note this term, that function of ensuring that sufficient goods are retained in stock to meet all the requirements without carrying unnecessary large stocks. Okay, so how are we going to make sure that we have enough stock but not a lot of stock is what we are trying to see. And what are the ways of inventory control? We have already studied one, which is maintaining the stock level. Okay, then on the basis of classification using ratio analysis and physical control, that we are going to see right now. Okay, so on the basis of classification, we have four classification: ABC analysis, FSN, VED, and HML. Okay, so ABC analysis is basically discriminating the products into three categories: A category, B category, and C category. Okay, uh, A category is basically where the value is very high, and the replenishment also is uh, needed. Okay, but it is usually the cost which is very high and very few quantity. B category will be those which are less important, less costly, and less investment also. C category, um, very less investment and large number of items. Okay, so that is what is the C category. So we, if you remember, we had ABC a question on this. That is what is ABC analysis over here. Okay, then we have FSN, that is fast moving, slow moving, and non moving. Fast moving items are kept closer to the department, in the stores department. Okay, and they are made fresh orders, frequent orders. Slow moving products are those which are reviewed periodically, and if they are getting obsolete, they will put into the non moving category. Okay, they are stored a little far. And non-moving items are those items which are just kept for disposal, and the details are given to the management so that they can give out the proper provision for losses, etc. Okay. Now, what are the reasons for slow moving and non-moving inventory? Um you may not have been technically updated. Okay, you may not have been knowing that you have those material. Okay, so that is basically lack of review. And it could be the failure of production department to communicate the requirement to the stores department. That could also be a reason. Okay, more the non-moving items, more the loss. Basically, that is what you have to keep in mind. Then you have VED, vital, essential, and desirable. Okay, vital are those that are basically if they are unavailable, they will stop the production. Okay, essential are those which are important but not as much as vital. Okay, they will cause loss of efficiency if they are not there, or so they are kind of second priority in the entire chain of things. So vital is the primary priority. If that does not happen, there is just absolutely no point. The production will stop. If essential, if you don't have essential items, you will have loss of efficiency, and substandardization would be possible. Desirable, these are just purely optional. If they're not there, it is not going to cause any loss. Okay. And then you have the high cost, medium cost, and low cost HML inventory. Now, whatever these four, I am going to revise this again for you. They are ways of inventory control on the basis of classification: ABC, FSN, fast moving, slow moving, non moving, vital, essential, desirable, HML, once I forgot, uh, high cost, medium cost, and low cost inventory. Okay, and all of these were ways of inventory control. The second way, the first way of inventory control is basically using stock levels. The second way of inventory control is classification. Third inventory control is using ratio analysis, which we have already done. The inventory turnover ratio, we have already done that. Input output ratio is also something that we have done in um, joint products and byproducts, so you know about that as well. And then we have physical control system. This you can read by yourself. They're very simple. Just have a quick reading. You don't have to buy at any of this. You don't. It is not that important actually. So don't buy at any of it. Okay. And lastly, we have the material issue procedure, but after a quick short break. Now, if the materials, how do you issue the materials? So, whichever department requires whatever materials, that department supervisor or foreman will be issuing something called as the material requisition note, and the worker will take that material requisition note, go to the storekeeper, collect the material. Okay, and the storekeeper will keep the MRN with him. Okay, then. If the material is left, there are multiple ways of doing it. It may be transferred back to the stores after the job is done, or it may be transferred to another job. Okay. If there is a transfer to another job, then there is a material transfer note that is issued. Okay. And the copy of it is given out to the cost accounting department because they have to make changes in the job. But the copy of that is not sent to the stores department because no changes are required. Okay. If at all there are chances that you have a lot of material requirement and you're not able to understand how much material is actually needed, then what you can do is you can use whatever you want and then return it to the storekeeper. Okay. Once the storekeeper gets all of the material back, they will issue a credit note, and the copy of it is handed over to the department who is returning the material, of course, and the copy of it is given to the accounting department so that they make a note of it in the cost. Okay. So these are the conditions for the material issue procedure. And then finally, we have the valuation of material issues as to how they will be valued. Now, the valuation method depends on how frequently the purchase are, how frequently the issues are, how much the pricing fluctuations, what kind of business nature it is, what management policy they have, and what kind of accounting systems they have. So, based on all of these conditions, there are three ways of doing it. One is the cost price method, the other is average price, the third is market price. So we have studied the cost price methods. We don't have the average price methods, simple average and weighted average. We only have weighted average, we don't have simple average. And then we have market price methods, replacement price, realizable price, notional prices. So we have all of this. You only need to know the names of all of that. You don't need to know anything extra. Okay. And we have dialogue and some commentary on what are the cost price methods. Okay, the cost price methods that you have, they've given us one lines to all of that. The specific price method, you have FIFO, you have LIFO, and that is it. Okay, so this chapter gets over here. I hope you've understood this. Now, what I want you to do is read the entire 10 pages again. Once you read those 10 pages, listen to me again, and then you will be done. Understood? Chalo. So this finishes this chapter. I will see you with a short break in another one.